Hi, good morning. In this presentation, I'll be dealing with chapter number 2, Analyzing Transactions. This first part of the video will be talking about the characteristics of an account and a chart of accounts. And the second item is describe and illustrate journalizing transactions using the double entry system of bookkeeping. And third one, I'll be taking out hands-on activity. I'll be uploading the format onto Blackboard. So please download that and work together with me. The format is Chapter 2, Classwork 01. The first learning objective is describe the characteristics of an account and a chart of accounts. As you know, accounting systems are designed to show the increases or decreases in each accounting equation element. If you remember, in the first chapter, we talked about the accounting equation being asset is equal to liabilities plus owner's equity. So any changes that happens in the asset account or the liability account or the equity account will be recorded in a separate record, and that particular record is known as an account. So in other words, any changes in assets, liabilities, and owner's equity will have a separate record, and each of that record is called an account. So this is the typical format of an account. On the top, we'll be writing the title. So this is a T-shape, but these days we don't use the T-shape. But however, to learn at this stage, it is very useful to use the T-shape. The left side of the T account is called the debit side, and the right side of the account is called the credit side. Now, supposing if there are transactions, several transactions, like on the left, your cash, this is an example of a cash account. So you can see on the left side, it's the debit side, and on the right side, it is the credit side. Now, cash account is an asset account. So in this T account, we are showing the records of the cash account. $25,000 of cash has been received, so it's on the debit side. We'll come to the rule then, but now you just do understand on the left hand side is the increased side and on the right hand side is the decreasing side. And then we calculate a balance, that is we add up the debit, that is 32,500, and add up the credit side before the line and then calculate the amount of balance to be 5,900. So that's a typical account. And chart of account is the next concept we will have to learn in this chapter. Chart of account is a group of accounts for a business entity, and the group of accounts is known as a ledger. So collection of accounts will be called as a ledger, and the chart is actually essentially lists the ledgers accounts, and that is why it is known as chart of accounts. Now we all know in the first chapter we learned assets are resources owned by the business, and some of the examples of the assets are cash, supplies, accounts receivable, buildings. Liabilities are debts owed to outsiders, and there are creditors, and some example of liabilities are accounts payable, notes payable, wages payable, or interest payable. Owner's equity is the residual right of the owner. I talked to you in the previous chapter that whatever money is put in by the owner and whatever growth, the growth of money that has been retained in the business is the owner's right. So owner's equity essentially is the owner's right to the assets of the business after all liabilities have been paid. So in other words, you've got to understand, if you have, let's say, assets of 100,000 and the business has to pay 20,000, so the remaining 80,000 belongs to the owner. But supposing if it is the other way around, assets are 100,000 and the payment to be made are 80,000, so the owner's equity will be only 20,000. For a proprietorship, the owner's equity is represented by a capital account, so we call it owner's capital account. and we open a drawings account which represents the amount of withdrawals made by the owner. Then the next thing that we'll have to talk is the revenues. We already discussed this in the first chapter. I'll just repeat that revenues are increases in the owner's equity as a result of providing services or selling products to customers. Some examples are fees earned, commission revenue, rent revenue, or interest revenue. If you see them, that is your revenue. The using up of assets or consuming services in the process of generating the revenue results in expenses. So, in other words, expenses are items that we spend to earn the revenue. So, some of the examples are wages expense, rent expense, miscellaneous expense. Now, this is a typical example of the chart of account, and as you can see, all assets are listed with starting with 1. So that means you can see cash is 11, accounts receivable 12, supplies 14, prepaid insurance is 15, and so on and so forth. So all assets will always start with a 1 digit, and liabilities we always quote them starting with 2, owner's equity with 3, revenues with 4, and expenses with 5. So that is one of the characteristics that you have to understand about the chart of accounts. Now it depends upon number of accounts that you may have. If you have very large accounts going into thousands, then probably the first account you may want to have as 1001, and then the second one to be 1002, and liabilities again to start with 2001 and 2002, and owner's equity with 3001 and 3002, revenues 4001, 4002. Similarly with the expenses as well. Now we go into the important learning objective: describe and illustrate the journalizing transactions using the double entry accounting system. Now, first, before I go into the learning objective, I'll have to be very clear and emphatic about the double entry system. Now, double entry system is a very old system, but it still is in practice. And it is, although there are many computer programs written to journalize automatically when you post your transactions, but still, as accounting students, you need to know how to journalize. Double entry system of bookkeeping or accounting. All businesses use what is called a double entry accounting system. This system is based on the accounting equation and requires every business transactions to be recorded in at least 2 accounts. So that means it is based on the fundamental principle of life as give and take. If you give something, then of course there will be a taking part. As if you take a benefit, there will be a cost for that benefit. So that is what the double entry system is based on. It is based on that. The total debits recorded for each transaction are to be equal to the credit. So that's how we check the arithmetical accuracy of our accounting. If the total debits equal total credits, that means we have done fairly well. But of course, it ignores the principal errors that you have made. However, it will be able to find out what kind of errors that you made arithmetically. Okay, the debits and credit rules for balance sheet accounts are as follows. For all assets accounts, debit for increases and credit for decreases. I repeat, for asset accounts, debit for increases and credit for decreases. So for example, if I receive cash is an asset account, and if I receive it, it should increase, therefore cash should be debited. And then I ask the next question, for what did I receive the cash? Supposing if I received because the owner gave me, then owner's capital account is to be credited. So now that's how you have to understand. Each and every transaction will have 2 sides, a debit and a credit side, and they have to be matched with the rule. For the assets, debit is for increase, credit for decrease. Liabilities, debit for decrease and credit for increase. Because the liability is on the other side of the accounting equation, it will have opposite rules. Similarly, owner's equity also will be the same as the liabilities. Credit for decrease increases, and debit for decreases. For income statement accounts, the debit and credit rules for income statement accounts are based on the relationship with the owner's equity. Now, as we talked about it, revenues will increase the owner's equity. So that is why if I want to increase my owner's equity, it should be credited. We learned that in the previous slide. Now, so that is why you can see the revenues account will be credited when they increase and debited when they decrease. Expense accounts, on the other hand, decrease the owner's equity. So that is why the rule is that if you want to decrease the owner's equity, you will have to credit it. We'll have to credit the expense account. So that's why expenses in decrease in expenses are credit and increases in expenses are debit. So the drawings account is a withdrawal account, and of course, if there is an increase in the drawings account, they'll be debited and decrease would be credited. Now, the summary of the rule is asset is equal to liabilities plus owner's equity. We know that. Now, what we can do is we can break the owner's equity into other accounts. So, asset will be equal to liabilities plus capital. That's the amount of money the owner has given plus any income the owner makes by doing business. So, in the first day of business, there will be no income. So, it could be zero. And the drawings minus the drawings. So, those are the typical accounts. Now, what we can do is we know how to calculate income. Income is revenue minus expense. So, therefore, if we expand the accounting equation, the new equation will be asset is equal to liabilities plus the initial capital plus revenue minus expense minus the drawings. And then when we bring the minus side on the left hand side, so that is the expense and the drawings account on the left hand side, we will get a final accounting equation for the purpose of rules of debit and credit as asset plus expense plus drawing is equal to liability plus capital plus revenue. Now the rule is if there is an increase on the left hand side, that should be debit, and if there is a decrease, it should be credit. On the other hand, across the accounting equation, if there is an increase, it should be credit, and if there is a decrease, it should be debit. So I've summarized the rules for the asset expense drawings account: debit for increases, credit for decreases for the three accounts, types of accounts. For liabilities, owner's capital and the revenue, they follow the same rules: credit for increases and debit for decreases. Okay, now what is a normal balance? Normal balance is either account can have a debit balance or a credit balance, but normally the increasing side is the debit balance, normal debit balance. So that is if an account increases if with a debit, that's the normal balance side. So all assets, expenses and drawings increase when we debit. So that means their normal balance should be a debit balance, all asset, expense and drawings. Similarly, liability accounts, owner's capital account and revenues account increase when we credit them. So therefore, that is the increasing side, and hence the normal balance of those accounts will be a credit balance. So you can have a look at the chart. That's how we'll be remembering them. Now, we are going to the journalizing part. Journalizing is the central focal point of this chapter. So you got to understand this. Let's take the steps first. Step number one is the date of the transaction is entered in the date column. Now, if you are not given any date, you can use a number just to make sure that we're following it, or sometimes you can just use a letter like A. But normally you will be given a date, and in real life we always know the date. Only in academic problems we run into a situation where we are not given the dates. Then don't get bogged down with that. You just use a number or numeric or alpha system of numbering them. Step number two is the title of the account to be debited is recorded at the left hand margin under the description column, and the amount to be debited is entered in the debit column. So that is now step number two. Step number three, the title of the account to be credited is listed below the right of the debited account, and the amount is credited in the credit column. But please understand, usually we will be using a indent when we write the credit account. So there are very important rules that you got to remember. Number one, you will always write the debit account first while journalizing. Write the credit account second with an indent. That's the rule that you have to understand. And a brief description may be entered below the credited account. The posting reference column is left blank when the journal entry is initially recorded. This column is used later when the journal entry amounts are transferred to the accounts in the ledger. So you will be writing the page number of the ledger in the posting reference. A transaction is initially entered in a record called a journal, and that is why. Now please understand the journal word jor comes from a Greek word which says on the basis of date. So that's why it is a chronological record of maintaining your books of accounts. The process of recording a transaction in a journal is called journalizing. The entry in the journal is called a journal entry. So supposing you have a transaction on November 1st, Chris Clark opens a new business and deposits 25,000 in a bank account in the name of Net Solution. So first thing what we are going to do is we are going to identify what are the two accounts. The two accounts are Chris Clark is the owner, so therefore he is bringing capital. So capital account is number one. Number two is the cash account because he has given cash by opening a bank account of 25,000. So that's one aspect that you have to really remember. First, identify the two accounts. One account is cash, the other is the capital account. And what kind of account is cash? So nature of cash, of course, is asset account. Cash is an asset account, and Chris Clark's capital is the capital account. So we'll apply the rule of debit and credit for asset and capital. Now the rules are increase in asset is debit and decrease is credit. So here in this case, I'm receiving as a business. Okay, another point that you have to remember is you have to always think from the business point of view. So as a business, I am receiving cash. So therefore, there's an increase in asset and it should be debited. So cash should be debited. And the owner is giving a capital. So I owe the owner. So therefore, the capital will also be increasing because it was zero today. Now he has given me 25,000. So his capital should be recorded at 25,000. So that is why capital is increasing. And you can see in the journal, the date was November 1st, 2013. And then you have debited cash accounts. And then after giving an indent, you have credited Chris Clark's capital account and you have written debit column 25,000 and in the credit column 25,000. So then you have also written a small kind of a narration or description as invested cash in net solution. So that description, you should not get bogged down with the description. You can just write a small note saying what is the journal about. And the posting reference, now what we do is we'll have to know the chart of accounts to actually do the posting reference. So we do not know the posting reference now, so we'll be leaving it blank, but when we know the posting reference, we'll be putting it. Now, please understand the journal will have a page number on the right hand side. So whenever you're referring that particular journal, you'll have to refer to that page when you post it to a ledger. We'll be talking about that. Now, I'm taking a hands-on activity. Please download Chapter 2 Classwork 01 from Blackboard. It is available under homework formats or classwork formats. So then we can do it together. Okay, now this is the handout, if you can see. First, we are given a chart of accounts. So the chart of account here is cash, accounts receivable, supplies, prepaid insurance, land. As you can see, as I have been saying to you, all asset accounts are starting with 1, liabilities are starting with 2, owner's equity is starting with 3, revenue starting with 4, and expenses starting with 5. So those are the chart of accounts. Then we are going into the transaction analysis. So this chapter deals with transaction analysis. First, what are the two accounts involved? On November 1st, Chris Clark opens a new business and deposits $25,000 in a bank account in the name of Net Solutions. So the first account is your cash account. And then next is the Chris Clark Capital. Okay. Now next thing is type of account. What type of account is cash? Of course, it's an asset. And Chris Clark Capital, of course, it is in capital account. Now cash is also increasing and capital is also increasing. Sometimes this could be a little difficult, but as you do, you'll be getting used to it. Okay, now the next thing is the debit account. Which account should be debited? Because asset has increased, so according to the rule of debit and credit, that should be the account that should be debit. So cash account will be debit and debit amount will be 25,000, and the credit account will be capital account and the amount is going to be also 25,000. So this is the first exercise. On the second one, it says November 5, Net Solutions paid 20,000 for the purchase of land as a future building site. So you are purchasing a land and of course you're paying cash. So the two accounts are land and cash. Now land is an asset. Cash is also an asset. What's happening to land? It is increasing because I just purchased it. And what is happening to cash? Of course, it is decreasing because I'm paying out cash. So now we have the two accounts, both the accounts are asset, and the rule for asset is increase is debit, decrease is credit. So therefore, I'll be debiting land. The amount is going to be 20,000, and I'll be crediting cash. The amount is going to be 20,000 as well. Okay, let's go on to the third one. On November 10, Net Solutions purchased supplies on account for 1350. So what are the two accounts? Of course, supplies on account would be accounts payable. If you Purchase anything. If you sell anything, that's receivable. Supplies is an asset. Accounts payable is a liability. Now, what is happening to supplies? It is increasing. What's happening to accounts payable? It is also increasing because we didn't have any accounts payable so far, and I just incurred a liability, so that will increase my liability from 0 to 1350. So what is the debit account? Of course, I have to follow the rule of debit and credit. Now the rule of debit and credit is, if there is an increase in asset, I should be debiting that asset. So that's why supplies account would be debit, and the amount will be 1350. And accounts payable is increasing, that's a liability account. So if a liability or a capital account increases, that should be credited. So that's why my accounts payable would be credit, and the amount is going to be 1350. All right, now let's take on to the next one. Number 18, Net Solutions received cash of 7,500 from customer for service provided. Okay, so when you receive a cash, and for what you're receiving, for services provided. Now we'll have to go to the chart of account and see what revenue are they using. They're using fees earned as the revenue, if you see the number 4, because as I said to you, revenues will be always coded as 4. So you are receiving cash, so that will be cash, and number 2 would be, of course, fees earned. Now cash is an asset, fees earned is a revenue, cash is increasing, revenue also is increasing. Okay, now if there is an increase in cash, it should be debited, so that's why I'm debiting cash. With what amount? 7,500. And I'll be crediting fees earned, and the amount is 7,500. Okay, next thing that we are given is, I think I need to freeze these accounts so I can see it. Okay, here it is. Number 30, Net Solutions incurred the following expenses and paid. So once you see the word paid, cash is involved. So first let's list the expenses. Wages expense, rent expense, utilities expense, miscellaneous expense, and then cash. Now these are all your expenses, and cash is an asset. Expenses have increased because they were 0, so now they are different amounts, so they have increased, increased. Cash but has decreased because I have paid. So what I'll do is I will be debiting all the expenses. So I'll be debiting wages expense, amount will be 2125. I'll be debiting rent expense, that will be 800, and utilities expense, that would be 450. And then miscellaneous expense, that will be 275. And the account to be credited will be cash. So cash will be credited with what amount? With the total of all these amounts. So let's sum them up. So there it is, 3,650. Cash would be credit because asset has decreased. So that is how we'll tackle that transaction. Now we take the other transaction. It says you are paid creditor. So as soon as you pay a creditor, please remember two things are happening. Account involved would be, one is the creditors are always accounts payable, and I'm paying cash, so therefore cash will be the second account. Accounts payable is a liability, cash is an asset. Liability, if you pay, of course it decreases. Cash, if you pay, of course it will also decrease. So if there is a decrease in a liability, it needs to be debited. So that's why accounts payable will be debited with what amount? With 950. And cash would be credited with 950 as well, because cash is an asset and it is decreasing. Okay. Next is net solutions. Purchase 1,300 supplies on November 10. Chris Clark determined that the cost of the supplies on hand on November 30 was 550. So that means what you need to understand is I have used some of the supplies. So if I use some of the supplies, I'll have to open a supplies expense account, because as I said to you, if I use any asset, that should be considered as an expense, and the other account will be supplies account because that's being affected. So supply expense is an expense account, supplies is an asset account. What is happening to supplies expense? It is increasing, supplies is decreasing because I have used that supplies. Now here, therefore, if you use the rule of debit and credit, what you're going to do is you're going to debit the supplies expense. And what would be the amount? Of course, now this is a little tricky. We have 1,350 of supplies purchased. Now I'm left with 550. So what is the supplies actually I have used? That will be the difference between the two. 1,350 minus 550 would be $800. So that is how we'll be handling that situation. Please understand that. And of course, supplies will also decrease from 1,350 to 550. So the decrease is 800. So that's how you handle that. Next is on November 30, Chris Clark withdrew 2,000 from Net Solutions for personal use. So the accounts are Chris Clark, drawings, and cash. Those are the two accounts. Chris Clark is a drawings account, we know, and cash is an asset account. Drawings is increasing and cash is decreasing. And therefore, drawings account will be debit with 2,000 and cash would be credit with 2,000. Now, how do you know it is a debit? Because drawings account, if they increase, they should be debited. Cash is an asset, and if they decrease, they should be credited. So that's what I've done. On December 1st, Net Solutions paid a premium of 2,400 for insurance policy for liability theft And 5, the policy covers a 1-year period. Now, of course, remember that it covers 1 year, and therefore it is a prepaid expense. So we'll have to write prepaid insurance. That's the account. And then now, of course, you may ask, how do I know that? Of course, I'll have to always refer my chart of accounts. So if there is any prepaid item, that should be, see here, there's a prepaid insurance. So that should be considered as the account heading. Prepaid insurance, and of course, I have paid cash. So that will be. Now, why I'm calling it prepaid insurance is because I'm accounting for December, and the insurance is paid for a whole year. So now always remember, prepaid expenses are asset because they give you a benefit in the future. Cash, of course, is an asset. Now, while talking of this, let me also mention any prepaid liability, that is prepaid revenue, is a liability. Because supposing if I receive some money in advance, and if I don't do that work for which I receive that amount, I should return that. So therefore it becomes a liability. But if you pay your expenses in advance, supposing if you have paid advance rent, you have the right to occupy that apartment for the amount that you have paid. So that's why it is an asset. Now prepaid is increasing, cash is decreasing because I paid. So following the rule, I'll be debiting prepaid insurance with the amount 2,400. Now please remember, as I use that prepaid insurance, it will become an expense. So at the end of December, I'll have to take out some part of that 2,400 and debit it to an insurance expense. So we'll do that when it comes. For now, cash should be credited with 2,400. Okay, next is December 1st net solutions paid rent for December. So if it is paid for rent, it has to be a rent expense, and you have paid it, so therefore it is cash. Now type of account, of course, rent expense is an expense, cash is an asset, rent expense is increasing, cash is decreasing because I'm paying it. And the amount would be, of course, debit account would be rent expense, because if expense increase, I need to debit. So rent expense debit with what amount? 800. And cash would be credit with 800. Okay. Now on December 1st, Net Solutions received an offer from a local retailer to rent the land purchased on November 5. The retailer plans to use the land as parking lot for its employees and customers. Net Solutions agreed to rent the land to the retailer for 3 months with the rent payable in advance. Net Solutions received 360 for 3 months rent. So now what you have to do is you have to understand what is the unearned rent. Sometimes they call it as a prepaid rent, pre-received rent, or unearned rent. So we go and see the chart of account, it says unearned rent. So let's use the unearned rent. That's one thing. And then next thing is I have received cash. So cash and unearned rent. Cash is an asset, unearned rent is a liability. Okay, now cash, you are receiving it, so therefore it is increasing, and unearned rent also increased because I didn't have any unearned rent so far. Now what should I debit? I should debit cash. Why? Because it is increasing and it is an asset. Out of the two, we'll have to always look for which one is to be debited and which one should be credited. So this is 360, and unearned rent would be credited with 360 as well. Okay. Now next thing is on December 4, Net Solutions purchase office equipment on account from Executive Supply for 1,800. So if you purchase equipment without paying for it, that is accounts payable. So we'll write equipment and accounts payable. Let's see, we'll verify the chart of accounts. Do they call it as equipment or some office equipment? Here they call it office equipment, so we'll have to also call it as office equipment. Okay, so this is office equipment. Now office equipment is an asset, accounts payable is a liability. It is increasing and this is also increasing. What should be debited? Office equipment should be debited because it's an asset and it is increasing according to the rule. When the assets increase, that should be debited with 1,800. And what should be credited? Of course, the accounts payable would be credited with 1,800. Number 6. Net Solutions paid 180 for a newspaper advertisement. Now the options are advertisement expense or miscellaneous expense, because we don't want to open accounts for each and every small thing that we do. So let's see the chart of account, what they call it. Do you have advertisement expense? No, I don't see. So we'll book it as miscellaneous expense. Okay, so this will be miscellaneous expense. And this is cash. Miscellaneous expense is an expense and cash is an asset. Miscellaneous expense is increasing and cash is decreasing. Now, if the expense increase, that should be debited. So I'll be debiting miscellaneous expense with the amount of 180, and therefore cash would be credited because cash is an asset and it is decreasing. So it should be credited. Okay. Let's go on to the next. Net Solutions paid creditors. Now, as soon as you see the creditors, it should be accounts payable and cash. Now, accounts payable is a liability account and cash is an asset account. Liability is decreasing because if I pay a liability, it will decrease. And cash, of course, because I'm using cash, it will also decrease. Now, when the liability decreases, I need to debit it. So that's why I'll be debiting accounts payable and the amount will be 400. And cash would be credited with 400 because cash is an asset account and it has decreased. So therefore, I should be crediting it. Okay, now next thing that we do is on December 13, Net Solutions paid a receptionist and a part-time assistant 950 for 2 weeks salary. So we are paying wages or salary. Let's see the chart of account. We have wages or salary. We have wages account. So we'll be booking that as wages expense. Wages expense and I'm paying cash. Type of account, wages expense is an expense and cash is an asset. And wages expense is increasing, cash is decreasing. So therefore I'll be debiting wages expense with the amount of money I paid. That will be 950 and cash would be credited with the 950 amount as well. Remember, the debit has to be equal to the credit always. Okay, next transaction is Net Solutions received 3,100 from fees earned for the first half of December. So now you have received 3,100 as fees earned. So the two accounts involved are cash account and fees earned account. Cash account is an asset account and fees earned is a revenue account. Cash is increasing because I'm receiving it. And fees earned is also increasing because I have earned it. So I'll be debiting cash with the amount of how much? 3,100. And fees earned would be credited with 3,100 as well. So that is how you handle it. Next is fees earned on account total 1,750 for the first half of December. So it means that I have earned but I have not received them. So that's why this will be considered as accounts receivable and fees earned. Accounts receivable is an asset, fees earned is a revenue, asset is increase, revenue is also increase. Now account receivable would be debit with also 1,750 and fees earned would be credit with 1,750. I'm applying the rule of debit and credit. Okay. Now next thing that we do is we check on December 20, Net Solutions paid 900 to Executive Supply Company on the 1800 debt owed from December 4. So we are paying our accounts payable. So that's why we'll be using accounts payable. And I'm paying cash. Now, accounts payable is a liability, cash is an asset. Accounts payable is decreasing because I am paying 900 out of that 1800, so therefore it should be decrease. And cash is also decreasing because I'm using cash to pay that. Now, what should be debited? Accounts payable is a liability and it is decreasing, so it should be debited. And amount would be I'm paid 900, so that is the amount that should be debited, and cash would be credited with 900 as well. Okay, on December 21, Net Solutions received 650 from customers in payment of their account. So now see the difference between the previous transaction and this. In the previous case, it was the creditor. In this case, it is a customer. So therefore, customer is always associated with accounts receivable. So the two accounts involved are cash and accounts receivable. Now, cash is an asset. Accounts receivable is also an asset. Cash is increasing and accounts receivable is decreasing. So increase in cash should be debited. So that's why I'm debiting amount of 650 and credit of accounts receivable, that is 650. Okay. Now on December 23rd, Net Solutions paid 1,450 for supply. So 1,450 was paid for supply. So the two accounts are supplies and cash. Supplies is an asset, cash is an asset. Supplies is increasing because I'm buying it, cash is decreasing because I paid cash. So the debit should be supplies because according to the rule of debit and credit, asset increases, that should be debited. And asset decreases, that should be credited. So cash is decreasing, so it should be credited. Okay. All right, now next one is on December 27, Net Solutions paid the receptionist and the part-time assistant 1,200 for 2 weeks wages. So again, I'm paying wages, so therefore it should be wages expense, and I'm paying cash. Wages expense is an expense account, cash is an asset account, and wages expense is increasing, cash is decreasing. So a wages expense is increasing, therefore it should be debit because that's the rule, and cash account is an asset, it should be credit. The amount will be 1,200, so cash would be credit 1,200. Okay. Now next one is net solutions paid is telephone bill for the month. So telephone bill would be considered as a utility expense. So let's see, we have, yes, we have utilities expense. So utilities expense and cash. Utility expense is an expense and cash is an asset. Expense is increasing and cash is decreasing. So your debit account will be utilities expense, and the amount is going to be 310, and cash would be credit 310. Okay, so that is how you will handle the utilities expense part. Now let's go on to the next one. Next one, it says is net solutions paid is electric bill. So do we have an electric expense account, or we'll book it as utilities? We'll book it as utilities because they don't have a separate account for that. So utilities expense and cash. So it is the same. This is an expense and this is an asset. Expense is increasing, asset is decreasing. When the expense increases, we debit that, and the amount is 225, and cash is credited with 225 as well. Okay, now next is on December 31st, net solutions received 2,870 from fees earned for the second half of December. So that means what we are doing is we are receiving for fees earned. So the two accounts involved are cash and fees earned. Type of account, asset, fees earned is a revenue. Asset is increasing and revenue is also increasing. So since cash is an asset, it is increasing, it should be debited and the amount will be 2870, and fees earned would be credited with 2870 as well, because the rule of debit credit is revenue should be credited when it increases. December 31st, fees earned on account total 1120 for the second half of December. Okay, so we are receiving are we receiving cash? No, they don't say. We have just earned. So therefore, we'll be using accounts receivable and fees earned. Accounts receivable is an asset. It is increasing. Fees earned is a revenue. It is increasing. Rule is if the asset increase, that should be debit. So that's why I'll be debiting accounts receivable, and the amount would be 1120, and I'll be crediting fees earned 1120. Okay, now we have come to the last transaction. On December 31st, Chris Clark withdrew 2000 for personal use. So if he withdraws, that is known as a drawings account. So we'll do drawings and then cash because he withdraws cash. Okay, now the type of account, drawings is a drawings account, cash is an asset account. Drawings account is increasing because he just withdrew that money. Cash is decreasing because he took away the money from the business. Drawings account, if it increases, we debit it. So we debit drawings. Amount is going to be 2000. And cash would be credit because cash is going out and reducing. So that will be 2000. So that is how you will handle all those transactions. All right, now what we are going to do is we are going to use this worksheet and do a journal entry in a proper format. So the first journal that we did was cash account was debit, capital was credit. So when you do in the journal format, so this is again, it has the format. What you are going to do is on, let me increase the size of this. Okay, so probably I'll develop another video for this because I think it is too long. So let's wind up this presentation.